Welcome to Tradiers, The Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. Thank you, guys. This is one of my favorite shows to do because of the live element to it, all the audience interaction. You guys are the best. We have the smartest audience anywhere. Also, join us at unfilteredinvestor.com, where we take some of the topics we talk about here and break them down to a more tradable, granular sort of thing. How are you, Bob? Bobby, two things. First of all, I got a haircut yesterday, and I hate every bit of it. I think it makes me look almost bald. I want to grow a goatee, but then I'm afraid people think I was trying to be you, and I can't have that.
Well, I don't have a goatee because I've got hair.
No, yeah, you're right. You do, yeah. Now,
so
anyway,
let me throw a couple of style tips out for you, and people are going to make fun of me for this, but I don't really give a shit. If you're going to have a beard, have a beard. Don't grow a goatee. Goatee's like it's just 1990. Do something more of a Tony Stark. I'll send you an image of that. Secondly, like as we get older, we need to cut our hair short. You don't know,
it just doesn't do the things I want it to do. Yeah, exactly.
You know?
Okay, the second item of business is we've had 3 people on the call so far, and you guys can see the W flag behind me. And 3 people who are not from Chicago all ask what the hell is the W for. Bobby, can we see your hat at this point in time too? 2 extra attaboys for anybody on Twitter who can tell us exactly what that W means. Actually, we've wasted our normal minute and a half not talking about markets at all, which is fine. Because as I've said a million times, you guys can think Bobby and I are full of shit. And oftentimes Bobby and I think Bobby and I are full of shit. But you cannot argue that we get excellent guests to say yes to come on this show, and we don't know why they do. So don't tell them about the nonsense that happens here. We have Mike McGlone, who's the senior commodity strategist for Bloomberg Intelligence and has been around the block for a long time and knows a lot about a lot. Let's bring in Mike. Mike, I'm so excited to talk to you, but it's been a long time. Where did we, in the past, when you were trading bonds, was that at ABN AMRO that I kind of assisted on your account a little bit? Was that way back then? Oh, you're muted, Mike.
I guess I didn't want you to have to hear me. At ABN AMRO, but we connected a lot in the pits. I just want to say I'm so honored to be on with you guys. I feel like we're brothers from different mothers, and my name does end with a vowel, although I'm just an Italian wannabe, so I married a good Italian.
Oh, did you really? Oh, so you have Italian children. That counts then, right?
Exactly.
My kids are half Polish, and I've always told them is that, so you're half Italian, so you like food and you like family, but you're also half Polish, so you really like to clean the kitchen. So get at it, baby. And you have a smattering of Irish, so you're going to eventually like to get drunk and fight. But anyway,
that's right. That's right. Well, I think it's just so I had to, you still have your trading code. I still have my trading code. I had to wear it to be on with you guys, just to be part of that. There's something that we realize as we mature in this world. We've so much we learn in those trading pits that you just can't get that anymore. Obviously, it's our bias because we got to use what we can, but there's just so much we learn. I'm sure we'll be talking about some of that stuff today.
Oh, no question, Bobby. I mean, it's about psychology too. It's about reading people. It's about talking to people, making friends with the right people. There's so much that goes into being successful. It was such a great environment. I loved every bit of it. And as you probably know, there's still 300 of us who trade short-term, SOFR rates, derivatives. And so we still have like about 1/10 of what it used to be, but nothing even close. Bobby?
Yeah, Mike and I reconnected speaking at the Wealth Summit last week, the Naples Wealth Summit. Mike and I spoke on the same panel, and we just naturally gravitated to each other because it's no offense to anybody else, but if you've been in the pit, it's like, I don't want to like overplay it, but it's like 2 football players like, hey, I remember you from '86. It's just you killed me that one day. And it was just kind of like we're having lunch together. And Mike was especially hard on the Bitcoin people at this particular conference. So kind of can't wait to go into it. But Mike, my first question for you is this. Jimmy and I have been on the gold train since about November of 23. And we're not gold bugs. But one of the things that I've been saying, Jimmy and I talked on the side one day, and we both agreed that it was getting a little long in the tooth, but I can't see a reason why it would collapse. Help me out here. Is there a reason?
Yeah, I'm with you on that one, and I'd like to show a chart on that if we can. It's So it's the problem I have with gold is fundamentally, technically, I was the same way you are. What I show you in this chart is a simple way of looking at gold. It's a monthly chart going back like 40 years. And if you just say gold divided by its 60-month moving average, some people would call this like a fourth standard deviation move, which like never happens. You got to go back to the peak in 2008. And that's significant because what I'm concerned is, so what I do sometimes as a strategist is sometimes fundamentally and technically have views, and then sometimes you have to switch over to risk manager. And I look at myself as a risk manager. If I'm bullish gold, if I'm talking bullish gold like you have for too long, this is not a place to be bullish gold. And for what reason it's going to go down, I don't know, but it's just completely scary. But what I want to overlay with what really scares me is this is not 120-day volatility on the S&P 500. If we end the month here, it'll be the lowest since 2018. This is something that's never happened in history since we went off the gold standard in 1971. We've never had such a high velocity move in gold with volatility this low. So just give you an example. This is in 2008. I use that as an example because we're actually above that now, but we popped up to 1,000 and then it dropped to 700 as the whole world collapsed. But when we started doing that, volatility was about double where it is now. And then it's peaked a year later. So I just look at this as an omen. I'm very concerned what it means, but overall, same as you. The key thing I like to end with is I took the pain in gold forever. I kept thinking it was going to go above 2000 in 2000, in 2001, in 2002, and 3, and finally 2004. I started out the year with quoting Roger Babson. The reverse of what he said is, in 1929, he says, I think I mentioned this on the panel, but I'll repeat what I said to you in last year and the year before. The stock market's going to go down. Well, I just reversed that and go, but now that we're up so much, it's just, I look at it as just quite scary. As a trader, I look at it as never an issue when you can take some profits.
So I have the reason why gold might go lower, and I want to hear you comment on it. Okay, because I just gave a speech in the New Orleans Investment Conference, and I think it's time to own physical gold, because if gold continues higher from here, it's going to mean the shit is kind of really hitting the fan. And I have no problem with hedging that in the paper markets, whether it be GLD or the futures. But here's my thesis of why it could go down. Okay, one of the reasons it's going up is obviously central bank buying. They're buying at a rate they haven't bought in 80 years, particularly led by China, India, Russia. Okay, so the trade war has obviously accelerated that a little bit, leaving more mistrust globally. And for perspective in this, and I'm not telling you anything you don't know, just in 2017, 64% of the world reserves were held in gold and U.S. Treasuries. Now that number's down to 57. Where's the balanced gold? So what if within the next 3 weeks, there's a picture of Trump and Xi holding hands saying we've hammered out a deal, we're best friends again, and implicit in it is that the Chinese government or the Bank of China is going to be back buying treasuries instead of buying gold. Is that something that's feasible? Could that happen? Would gold drop 20% because of that, or what?
Yeah, I think in this case, it's the kind of thing where I do look at it, something like this. When it gets just stretched, it just looks for an excuse. That's one good potential for excuse. Another one being maybe some detente in the Russia-Ukraine war, which was decisively enabled by Mr. Z, according to the NATO, something like that. But I think you're at the right path. And there's another key thing. There's a couple other things. Another thing is, look what happened in 2008. It was a raging bull market, but it went down because the stock market went down and we hit stops. Now that's happening in cryptos right now. They're hitting stops on the way down. And another key thing that could do it is just say the VIX stays real low, volatility stays real low, and the stock market stays resilient. Why buy gold in that environment? And so there's a lot of reasons it could go. I just look at it when it gets this level as a money strategist, money manager, trader, investor. Yeah, you don't want to be overweight long here. You want it to be overweight long here down in 22, 23. It just took a lot of pain to finally break out.
Right. I want to get by with the next question, but I want to say one other thing. In a period where Trump administration is talking about throwing $2,000 checks to everybody but the three of us. I know whatever the plan is, I don't even know what the threshold is. I know it's just everybody minus 3 people who are on this call right now. We're not getting checks. But when you hear them saying bullshit like that, do you think, God, they have no respect for the dollar. I might as well stay in the lack of confidence trade?
Well, that's one thing. Simple thing is the gold market absolutely loves Mr. Trump. Thank you very much. Push back on the Fed. You're not going to create inflation by cutting rates and when the punch bowl needs to be taken away with markets. It's just the bottom line is gold just loves this man.
Bobby?
Mike Tichy put Cubs in the
damn straight, Mike. Here, Thank you, brother.
Yeah, I mean, he knows you wouldn't say Cubs unless you knew exactly what it meant, so we'll give it to him.
Yep.
We don't have a prize for you, Mike.
Oh, he gets 2 attaboys. Attaboy. He wins.
2 attaboys. So I want to go back to gold 1 second, Mike, and then I do want to switch to Bitcoin before we get to regular markets. If I'm going to give you guys my thesis. To me, the only reason gold would go lower, okay? Like you said, yeah, we got a deal, Jim. But does that deal mean China is now like, yeah, let's buy treasuries again. Let's dump gold. Or do they continue to accumulate gold? I think they probably still continue to accumulate gold. That's number one. Number two, you just look at the price action of gold. We had I think it was like a 10.8% drop. That's the first correction we've had in gold, I don't know, for like a million years. Don't quote me on the time frame. The last 3 corrections have been sideways corrections, and we're in another one of those now that didn't really last long. When you see moves like this from a technical perspective, you get the weak hands selling off. The people who bought at 3,900 to 4,100, it starts to collapse. They're like, I got to get out. It's not going any higher. Those are the people that helped it go parabolic, right? And now it's going sideways and then slightly up again. That tells me is the speculators that bought near the highs are selling it. But the people like you, like the 3 of us who bought it a while back are like, no, not yet.
But I'm hedging. I have
that's number 1.
Yeah.
That's actually number 2. Number 3, we have a Fed that may not be cutting anymore, but they're certainly not tightening, right? If you look at, if anyone's predicting a recession, the last 4 recessions, gold essentially was up 20%, 30%, 18%, and 25%, right? Contrast that with silver, up 8, up 10, minus 5, up 15. Forget about platinum. It was garbage. So we're either going into a stronger economy with a Fed easing because of a slightly weaker labor market. And to Jim, to your point, AI may make that worse. We're going into an inflationary environment where the Fed is not fighting it, or we're going into a recession. In terms of the next economic regime, I don't see anything outside of those 3.
Well, I think what Mike's saying, that's already priced into the stretch. Yes, Mike?
Yeah, that's my problem. There's, markets look ahead. And the key thing is, I love what you mentioned, Bob. Sometimes there's so much you can learn from a chart just by interpreting. No, then it's also, it's the art of the business is pattern recognition. And that gold pattern, when it first popped up to 3,500 in April, 5 months of a perfect bull flag was just, oh my gosh, I've never seen a better chart. So now we popped up to a 4,000, but now I think that's the problem is I turn off all my fundamentals, and when I see a market this stretched, I just say it's the number 1 lesson. I remember being with clients, when you get a client in a good trade, get always try to take some profits. First of all, you get the trade, but then you get the next trade. So it's just the essence of the business.
Yeah. So here's my question then is that, okay, so gold, and I actually have put hedges on in gold, and I'm very comfortable with those because I agree with you to a certain extent. We made quite a bit of money on it. What now do we look at? Like, what is your thesis for the economy, and what sectors could benefit from whatever the Fed will do, the federal government will do, et cetera? Take that question wherever you want.
So my thesis, I'm glad you asked it. I want to start out with showing a long-term chart. And that is that we are way overdue for some normal deflation from inflation. So my thesis for the last few years, as most people know, I've spoken before, but I've been not on board on the stock market, bull market, but I jumped on cryptos. I mean, Bitcoin was just an awesome trade. I had a love-hate relationship with Bitcoin and cryptos with the Trump administration. When they hated it, I loved it. And now that they love it, I hate it. But the key thing I want to point out is the macro here. And this is a chart that I show I find quite disturbing. I think it's going to get a little reversion. So first I'm showing you this, the S&P 500 divided by the MSCI XU index. It's the highest ever in history. So the U.S.
What does it mean? What does it mean? What does that mean exactly?
It means the U.S. So there's different ways to look at the valuation of the U.S. stock market. So the bottom line is it means the value of all U.S. stocks, which is mostly only 7, is the greatest ever versus the rest of the world. So that's one measure of how relatively expensive we are. Just a little reversion in that is quite significant. But on the same scale, I show the S&P 500 divided by GDP. Now, this is a Warren Buffett model. Just take in terms of GDP and just knock off 2 zeros and you get that same ratio. It's the highest since 1928 on the way back up and then down in 29. So, and then also I just point out something that's never, let's talk about things that's never happened. This is just how many ounces of gold or how many barrels of crude oil per ounce of gold. It's 72. We've never ended the year above 39. That's 100 years. So the stuff that's going on in markets with crude oil collapsing, the world's most significant industrial metal, and gold taking off is just, I find it's a great environment for a trader, which we are, but a horrible environment, I think, for those who've been buying and holding forever in the middle of the greatest wealth effect ever. So to me, here's what's, I think, kicked in with those elections last week. We had a major Democratic sweep, and the major theme was inflation or cost of living, and that's the thing that Trump's getting wrong. And I did enjoy writing about what he got wrong about cryptos in first administration. So now I'm going to write about what I think he's getting wrong now, and I just published on that today. He's missing the fact by pumping up the stock market at 2.3 to 4 times GDP, or 2.3 to 4, the highest ever. He's elevating the wealth effect and stock market and inflation, which is the number one thing that helps 55% of the population in this country who are wage earners who voted for him. It hurts them, the inflation, but it helps the average, top 10% or 20% of the wealth in this country, which is basically us who own stocks and homes, and inflation's good for us. So I think this is part of his lose-lose that's kicking in. And the number one place to see that the tip of the iceberg tick down is Bitcoin. And Bitcoin is, it's the absolute tip of the iceberg of risk assets. The tip of that tip is MicroStrategy. That's already broken down. And this is just a monthly chart of Bitcoin. I showed you, we mentioned the monthly chart of gold. To me, this is the exact opposite. It's breaking down. It's holding at 100,000 like it should, 110,000 first resistance. But here's one thing I want to end with and point out that's different from the past. They talk about a 4-year cycle, Bitcoin, just like the presidential cycle is a 4-year cycle. But so 48 months is 4 years. That correlation of Bitcoin, the S&P 500, is the highest, just about the highest ever. Beginning of 2020, it was negative. And the key thing I'll point out is the 48-month moving average, which it always goes back to, which people tell me it's not going to be anymore, is 55,000. So I'm like, man, just a little reversion, get back to that level, and then I might be considering getting bullish this asset again.
Which is funny. I was just going over the correlations today. And Bobby, it's your question, but correlation, not just with the NASDAQ with Bitcoin, but correlations with all the indexes. I don't check the Dow, but all the other three is amazing. Which suggests to me that it all has to do with shit tons of money being thrown into the system, probably an extra 4 trillion in M2 money supply just after the 2020, 2021 bullshit. Bobby, what do you got?
Yeah, I want you to, Mike, you talked to me about something in person last week. Was it last week or the week before?
That was last week. Yeah. We're busy.
You mentioned about Bitcoin moving toward its, I believe you said 48-month moving average.
Yeah.
Go into that. And if I said it wrong, correct me.
Oh yeah, that's the one we're looking at right now, but you can pick any moving average, except I just like to keep them a little longer term. That's just the key thing that I like to point out. It also assumes that the stock market's having a problem. Obviously, that's quite resilient, but you just look for sparks. And I just like to point out the key thing that's really been happening this year is I look at a broad basket of indices. This is shorter term. So if you look at the Bloomberg Galaxy Crypto Index, it's down 2% on the year. Now, this is a year it's not supposed to happen. Remember, everybody is like, oh, yes, Trump administration is great. We're going to have a Bitcoin reserve. And, massive inflows into gold, into crypto ETFs, yet the index is down 2.3% on the year. And I want to compare that to the market. I think is going to be next big trade being from the bond pit. Is this TLT, total return? That's the ETF that tracks the bond future. It's up 7%. So despite the fact that this Galaxy index, this crypto index, trades like probably many X's the volatility of the bonds, it's down. And then all this stuff is, and it's not even keeping up with beta. The S&P 500 is up 18%. So we're trying to look for signals ahead of the game. And to me, that's a sign that the game is over. I don't know what's going to make that happen. I'm just afraid that when we do finally get the S&P 500 to say drop 10%, get back to its 200-day moving average, what does that mean for all these assets that are already failing versus beta?
I will say one thing is that last week there was a day that the stock market had a really difficult time. And it seemed to me that it was kicked off by Bitcoin falling through some significant levels. You guys saw the same thing I did, right? I know that Carly Garner posted about it right as it was happening, which to me, it kind of changed the way I'm looking at it. And I agree with you on the tip of the spear thesis, Bobby.
So let's switch gears a little bit here, because again, I feel like I know what you're going to say about a lot of that stuff. So I want to move on to something I don't know about, or I don't know what you're going to say about, I should say. In terms of AI, we're seeing weakness in that space, are we not? Do you think that's in a bubble? Do you think that's just sort of the pause that refreshes? What's your feeling about that sector as a sector?
Well, I definitely want to know your views on it, because I don't watch it as closely, but I watched, there was a MEME ETF that's down,
Yeah.
like I showed was down 2%, but it's the kind of thing that we all know from Buffett. Sometimes it's great to identify a bubble and join it. I did that in Bitcoin and cryptos. I got off a little too early last year, but it was nice to take a 10x out of it in general. And we all know that's what it is right now. It's a classic bubble. Question is, when does it peak and how does it peak? And that's my job, is try to look for those inflection points. And it's a key thing I love that we all have in common, is we can I would consider ourselves professional tape readers. It's just a thing you learn in the pit. You watch all correlations and things moving, with crude oil's going down and bonds are doing this and stock market's doing this, and you look for those correlations. But the key thing I like to point out is, like Jim said, we've seen Bitcoin leading stuff lower, and I think the memes are probably going to be part of that's the last thing to go. But it's just a matter of time. I think you can get some kind of inflection point, and the whole thing just, gives back 30%, which is way overdue for, and just get back to, just imagine getting back to a 200-day moving average in S&P 500. That's about 6,100. That stuff used to happen. It's just a question of when.
It was normal. Bobby, just to say to you, Mike, I don't know if you've seen me say on the show too, that is my base case too, that the Magnificent Seven will have a 30% haircut sometime in the next year and a half. By the way, and I do believe it's in some level of bubble, which is almost worthless to be able to say that, except for the fact that I do think you should trim and trail. I do think you should have options protection. I've started buying options, put spreads in that's MAGS, that ETF that you turned me on to, Bobby. But because I am worried about that sector quite a bit. We had what was the guy's name who said, people who say we're in a bubble and then say, but that you should still be in it, they're idiots. And I'm like, well, they're not all idiots.
Trade it.
Yeah,
It's how you trade it too. No, you got to trade it. Well, trade some option strategy with a little positive gamma. That's the way to do it. I mean, but the key thing is how you trade it and how you stop yourself. And that's the thing we learned, and I learned as part of the reason I am a strategist. I remember when I left the pits in '93 to trade in New York, and one of my bosses told me, Mike, you say it a lot better than you do it, because trading's hard. I can be right and still lose money on the trade. So I just focus on being a strategist. And I have to admit, sometimes it's so important to admit when I'm wrong and point out what that means why. And the key thing I've been wrong on for 2 years now is I keep thinking the next big trade is those good old treasury bonds, but we haven't got there yet. And bottom line, I think it's because the stock market's so expensive, creating so much inflation. It just needs a little bit of I think Trump will get this. If we can just tweak that a little bit, he'll get everything he needs for the midterms: inflation to go down, energy to go down. And then by that time we get there, maybe start recovering, but he's not getting that yet.
So there's a question here that I want to ask. I'm just getting Luis ready to put it up on the screen here. It's Stock Charts, Mike, if you don't follow him, you should. And Remo, you should follow. You should follow Remo's Mike as well. Yeah. And Mike's Twitter will be on the screen at the end of the show. What are your thoughts on crude oil? Now, I have mine, but this time I want to hear yours first.
Yeah, it's right now about $58 a barrel. It's stuck between 40 and 80. And I'll repeat what I've been saying for almost 3 years. I think it's more likely to go to 40 than 80. And just a little tweak. So we all know the key thing is the consensus. Now, I started making that call when it popped above 100 in 2022, and mainly because I read the right books. And one key book was The Price of Tomorrow by Jeff Booth. Technology is happening so fast. And to me, it's a matter of time. But the key thing, it's leading the deflationary forces. Now we know what's happening. I mean, just to point out, my electric car is 11 years old. But the thing to remember about crude oil is it's bottom around 40 3 times since 2008. What stops that? And every single time it bottomed, the U.S. was a net importer of crude oil. In 2020, we're still kind of flat. Now we're exporting up to 4 million barrels a day of liquid fuels. It's just the world's shifted. And not only that, here's one key little trigger that might get crude oil right now at 58 to just print a 40 handle. It's just a 10% correction S&P 500, stuff that used to happen. And the key question will be when it corrects next. How long does it, see, we're overdue for one of those corrections that stays down for years. We're overdue for that. And that's going to be severe deflation. But that's not profound to say that. Another book, The Price of Time by Edward Chancellor, just pointed out every cycle in history, after major pumps of inflation and liquidity and money supply and risk assets like we had up to the 2022 and now, you always get deflation. That's clearly what's happening in China. And that's one thing I want to point out is 1.8% is that 10-year note yield in China. I started trading Japanese government bonds when they're much higher. Jim, I think we might have crossed a few trades on that. And U.S. right now is at 4.07. And the whole thing, everything, the main thing that's holding the whole world back from a normal deflationary cycle, most notably U.S., is U.S. stock market.
So tell me this,
I'll tell
Mike.
you that, Jimmy,
Oh,
if I
you go,
could real
Bobby.
quick, I'll tell you that it looks very likely that I get a longer term short signal on crude oil Friday. And all it has to do now at this point is close below last week's close, which was 59.75, which is highly likely. And then it takes my targets to the obvious loan, which is 55.96, which was the low of October, the week of October 20th. But then I have a low as far as 48.41. I have a target of 48.41 for this particular trade. If it actually happens, that gives me great risk reward. The 200-day moving average is still sloping up, but we're so solidly below it. Let me reword that. 200-week moving average is still sloping up, but we're so solidly below it. Once it turns down, I have never seen crude oil on a weekly basis break out to the upside once that 200-week turns and angles down, unless there's a war, unless there's a geopolitical scare.
Is it telling us that China's shit?
Well, I think it's telling, my opinion, is telling us the whole world globally is shit, which is why I brought up the recession thing. Why I brought up gold's performance during the recession, because I think globally we're weak. We saw weak UK data in the labor front early Tuesday morning. The only thing we saw strong out of Europe, including the UK, over the last few days was the Eurozone's EEW business conditions. NFIB, Jenny, which you follow closely, was weaker than expected. Maybe a lot of this has to do with the government shutdown, but certainly the data in the UK doesn't. So I just go.
Take a quick time out. Just a quick time out. Luis, can you put the banner up? This is halfway through the show. This is where I ask a favor from you guys watching us. Please, if you want to support the show, try Tradier Pro options trading platform for free for 3 months. All you have to do is scan the code there. We talk to options traders all the time. Some who have been doing it for decades, some have been doing it for days, and they all say that Tradier Pro is of a tremendous value. So just scan that code, try it for 3 months. Thank you guys for supporting the show. The commercial's over. So
real quick, Luis, if you could put up Shavon's question there. He said, what is the book Mike just mentioned?
The Price of Time by Edward Chancellor points out deflationary forces always follow inflation that we had, akin to what just happened recently. There's another book called Boom and Bust. Quinn is the author. And of course, this is all replay, you can replay it. But the key ones that really got me bearish crude oil was a book called The Domino Effect by Brazil. Don't pronounce it properly. And that one I read a long time ago, just about the shale revolution. But the big one, the macro one, I know the author, his name is Jeff Booth, we're friends, was The Price of Tomorrow. And he just pointed out technology is moving so fast. Why is copper and silver doing well? That electrification, and crude oil getting hammered because we're replacing it. But that's one thing I want to rope in quick, if I can, is the disparity between what's happening in crude and copper. They're the world's most significant industrial commodities, and we've never had a year, actually only one, 2020, where crude oil has been down this much and copper has been up this much. And it's scary, this stuff. I just find this stuff frightening. I say that from a standard person who've been overweight long, got overweight long, has been involved in the risk assets for 20 years, and just can't help but enjoy that wealth. But for traders like us, this is tremendous opportunities. And I feel that like the next big trade in commodities, obviously the big trade this year was gold. The next big trade is what's going to happen with copper. And I'm afraid if it just does a normal thing and drops, that's part of the whole cycle tilting downward.
Interesting. So tell me this. So what's his name? Jerome Powell bent on easing. One of the theses I have is that the only reason he hit the gas pedal on inflation back in 2021 is because he fully understands that the federal government, 5 states around this country, many of the counties cannot pay their bills unless we monetize the shit out of debt. I think when he said inflation is transitory, I think he was expressing a worry that it was transitory and he needed it to stay around. I don't believe him when he says his target's 2%. I think he would love to make a 3-year trade of 2.7%. You've said the word deflation or disinflation about 3 or 4 times. What do you think? Do you think he's worried about the same things you are? Is he worried about AI destroying the labor market? Is he worried about monetizing debt of over-indebted government entities? Or is it a cocktail of the 3?
I think he is a genuine governor who knows his history and studied his history. So remember at the end of 2021, and he warned he'd be tight, and he mentioned Paul Volcker. No person in his position wants to be remembered as Arthur Burns, who cozied up with Nixon and created that inflation. They don't want to be going down in their history for hundreds of years for their name to go down like Arthur Burns. Now, when he died, he had a great obit in the New York Times. I think he was in the cover. They loved him. But years later, they found out what happened. Let's remember about Mr. Powell. He was appointed by Mr. Trump. And that's what happens, I think, in this wonderful country of ours. We have a natural check and balance. Once you get a human being in a position where their legacy is going to depend on their decisions, they might say, I don't care what you say, Mr. President. I have to focus on what's the right thing to do. And I think he gets the issue with inflation. And the thing that Mackenzie Martin said is, yeah, when the party gets out of hand, you're supposed to take away the punch bowl. And he just kind of hinted that at the last meeting. We shouldn't be easing in this environment. Partly because the stock market's on such a tear. Inflation's above average, above his targets. And I do believe that they're going to get 2%, but I'll make a prediction. We've had 37 straight months of negative PPI in China, despite the fact that they are pumping more money in their system than we ever did. That's a normal deflationary cycle, just like Japan did 30 years ago, and it's finally getting out of it. We're overdue for it. And there's the number one factor for all inflation or deflation in this country is the stock market. It's the 10 on a 1 to 10 scale, but bar none. I mean, we're 2.3 times GDP, and you can see it. Every time it goes up, inflation gets picked up. If it goes down, inflation measures go down with a lag. And that's the lose-lose night now for Mr. Trump. He talks up the stock market, but at a certain level, I think Powell gets it. If you can just get that little alleviation, just a little 10% correction, we're going to get CPI at 0. And I'm probably put unemployment. We'll get crude oil to go to 40. We'll get the bond yield at 4.6 to go to 3. And that's just an easy thing, but it's because we're so stretched right now. I think the markets are just waiting for that, and it's not getting it. It's not getting that little pullback. So to me, inflation's all now about the stock market. I think
Bobby, he just answered my question already. I was going to say, is the trade of the next 2 years being long the 10-year? And to me, you just said yes. That's probably the trade, right?
So it is, but I've been saying that for the last 2 years. So check mark. I've been getting beat up on that one, but that's some of the best trades.
Until you're right. That doesn't mean you're wrong tomorrow,
eventually, right?
Bobby. Yeah.
All right, I got a question that I want to ask from the chat, and then I have my own question, Jimmy, if you don't mind.
Not at all.
Again, it's stock charts. So if crude is headed lower, deflation, dividend stocks, bonds, and wouldn't a global gold be an economic hedge, I guess is what he's saying there.
Not if it's stretched, but anyway, sorry. Yeah.
So I want to contribute to that. This is a key thing I enjoy, and potentially I think it's part of our age factor. You have ask your typical 30 or 40 something, and the first thing they say when you say they get out of risk assets is, what am I supposed to buy? Have not seen that normal correction yet, which is we are so overdue for some wealth destruction. So the key thing I want to point out is since the start of 2000, we've had more than 50% drawdowns in the S&P 500, and people are just incoherent that it's ever going to happen again. I'm pointing out at some point we're going to get that. It may be starting soon. I mean, certainly happening in things like cryptos, and it's happening in China. So that to me is the key thing. Is there's a certain time. So I tilt to my overweight bonds more now than ever. Just U.S. Treasury, simple old, buy some duration. Partly because that's what's happening in China and most of the rest of the world, and they're clamoring to get someplace to export to, and the U.S. just shut them off. And just to tilt over what you mentioned earlier, the whole world's facing the most significant shift in their ability to export stuff to the world's largest demand pull economy in the planet in history. We're shutting that off. So I think the last couple trades was cryptos and Bitcoin. You got alpha from there versus stock market. That ended this year, I think. And then gold, you got alpha versus the stock market and ancient store value. Sounds like an oxymoron, but that's really scary. That's getting scary. To me, the next big trade is just sitting back and clipping some coupons and not losing money when everybody else does.
I love that.
All right, so here's my question. It's a little bit of a trick question. I want something out of both of you for this. 50-year mortgage. Go.
Go, Jim. I think it's kind of silly, but
so first of all, the 50, it's dumb. Okay. It's dumb. The exact same thing as the interest only mortgage that was part of the part of the driving up of the bubble in 2006 and 2007. Because again, if it's the same rate for 50 and 30 year, all that's different in the payment is going to be the principal that you're paying 1/10 of on your first few payments. So it's stupid. Can it be valuable to somebody? Yeah. If this housing market is going to go through the roof, if you think the government's going to be increasing their spending and blowing up the M2 money supply and you need to be in a home, it could work. But I think it's somewhat silly. It could drive up the price of homes too if you're dragging people in. It's silly. What should be I don't know if it's possible to make mortgages portable. But what happened in 2001 was 2021 is going to be taught in business schools for forever. The rapidity of which we raised rates from 2.8% mortgages to 7.5% mortgages in 10 months time locked up the supply, and nobody predicted it because those guys are a bunch of idiots. We could have predicted it. So make them portable. Don't let BlackRock and Blackstone own 18% of the housing stock. And maybe you'll deregulate the shit out of the housing market if you want affordable housing. Mike, what did I miss?
So I think you nailed it. I just want to put out the macro solution. I'm just kind of getting concerned about these gimmick type things versus the macro from our administration. And that's the simple way is, first of all, the housing market's the most expensive ever, typical residential housing for a typical income in this country ever. And the stock market is the most expensive versus housing ever. And I started publishing that last year. So that's just how elevated the wealth effect is. It's been wonderful, but at a certain point, the best thing to help all this thing work out is just a little recession, maybe just and dropping everything 20%, hang out for a while, everything resets, gets cheap. As long as you keep your job or find another one and move on. That's, to me, is the number one factor. Bring on more supply organically, but gimmicks like that are just kind of scary. And that's why I look at a simple solution is just a little backup. And all that starts is in cryptos. There's so many people who are gambling now because they're trying to get ahead to buy a home. And you know what happens with those typical things. Only a few make it and do well. The rest just get hammered.
So when I want to
if I can go back to that real quick, most of the problem with housing is local. It's not like you shouldn't be addressing it on a national level. That to me is the problem. And one of the things I've been disappointed in the administration is we're not hearing at least about just a rash of deregulation. And one of the places, and I know this from down here in Florida, is there's so much to go through to build new homes. And there's a lot of homes going up here. And some of the new home builders, they're being very successful buying down mortgage rates, right, for the people who want to buy them. But you need supply. And one of the biggest problems with supply is regulation.
Yeah. So,
but that's
a quick story to that regulation
in a lot of cases.
When I was building my Colorado home, it was probably 16, 17 years ago. We had to halt construction for 8 months. I believe it was 8 months because there was a nest with two. It wasn't like a rare bird or anything like that. It was like a robin. And the builders are like, oh no, we can't touch the nest. We have to wait until the birds hatch and go. I was like, wow. What do you like, dude? I eat birds. Like, can't we just cook those babies up and get going? And they were like, no, that's not the way it works out here. And that to me underscored the whole thing that nobody can build a 3-bedroom, 2-bath starter home on a quarter-acre lot because the regulatory hurdles are probably the first $80,000 of it. So the only thing they're building is the McMansions that are going to cost $600,000. Mike, how do we address the housing problem?
Well, I think you nailed it and Bob nailed it. It's a local thing. I look on the macro, but you just remind me of that movie Shrek. Remember Shrek 1 when Fiona ate the birds, the eggs, and scrambled eggs out of them? I mean, that's like, I love animals and everything. As my kids say, they taste yummy.
I just had some chicken and eggs. The plate's sitting right here. I wouldn't have waited 8 months for that. Yeah, what anyway? Right. Yeah. So here's another
commodities. You mentioned that. Yeah, I'm sorry, Jim. I just want to ask a commodity question again. You mentioned the divergence between copper and crude oil. It's only happened one other time in, I don't know, a million years.
Yeah.
What does it tell you other than electrification, if anything?
Yeah, so I want to show a chart on that. This is an annual chart I'm showing of copper in the middle. It's stuck at $5. It's the high for this year is right around 6. The low's been around 4. But what I overlay it with is the S&P 500 on the same scale. You take the S&P 500, divide by 1,000, and it's the same as copper. In pound takes off and copper's hanging out. But at the same time, crude oil is breaking down. This has never happened. So my base case for next year is, maybe crude oil can get above 70. I don't know what it's going to take, but if it does that, it's going to bring on more supply, which is a problem. It's more like it can go to 40. So the key thing is the whole world in commodities is basically Atlas's burden is on copper. So if copper just does a normal reversion towards 4, which I think it always does, and I think it will, that is the deflationary dominoes kicking in commodities. And to me, that's why it's so important. But the key thing I also want to point out, it's not just Crude oil. Crude oil is in the same bucket as the grains. Corn, soybeans, and wheat, they're all oversupplied, most notably from supply in Brazil because prices went up too much. It's the cycle's all downward. And what shifts that for next year is this copper's got to go up. Otherwise, I'm just afraid to just get a normal correction, 10% in the stock market, 20%. Copper's going to go right back to 4, and what it always does. But to close above a new high, number one, you need the stock market to actually make a new high. Probably has to go up. It's a prerequisite. Everything's so correlated. You need China to come out of its funk, yet the whole world's pushing back on their exports, most notably the U.S. And we're just overdue for that normal recession. So copper to me, the metal known as a PhD in economics, is more important now. And I'll end with this. Right now, it's about $5. It's stuck there. So I think 4 is more likely than 6. And it's never ended the year above 446. But so we have a month and a half. If it drops below 446, it's still just a normal year for copper. But it's also distorted by tariffs, and we've had a significant amount of supply disruptions this year, which always means short-term gain for a longer-term pain.
Okay, so here's my question. It's going to be a macroeconomic question, and it's about the Trump administration. So just so you know our history, both Bobby and I, we've talked about it openly. We voted for Trump. We've been very, very critical about many of the policies, particularly ones that you called gimmicks. We echo that 100%. But he does seem to be getting a lot of commitments. I'm doing air quotes for people who are listening because I don't know what the bullshit level is of the commitments he's getting from around the world to direct business here, investment in this country, different large caps bringing back investment because to avoid tariffs, shit like that. Do you think there's a possibility that somewhere around midway through next year, towards the end of next year, we start to see a domestic economic boom? By the way, at the expense of the rest of the world, potentially, if we're moving things from all these other developing economies. Do you believe the things the president's saying? Do you think it's a lot of malarkey, to quote the former president?
Yeah, I love that quote. It was in one of his debates a long time ago. He said that, right? Yeah.
Get your ball off my ball now.
I think what you pointed out is some of the things that I really enjoy. And travel, I was in London a couple months ago. I really appreciate about Mr. Trump and what this country does is we swing for the fences. No other country in our size can do this. And we elected him, and it's a tremendous experiment. If he succeeds, the whole world's going to just, right now they have that, eyes wide open, like, oh my gosh, how are we going to keep up with these guys? And it'll shape the world, certainly our country, for 100 years. The key thing is he has potentially the timing is Herbert Hoover. He became president with the stock market the most expensive since Herbert Hoover got elected. And that's the risk. We have a normal correction. The key thing I'm worried about is there's another book called No Trade is Free by Robert Lighthizer. I read it the day he got elected. I just clicked on him, and Robert Lighthizer absolutely nailed everything Trump's been doing. And it makes sense. So here's a key thing I learned in grad school when I was working at the Board of Trade in the 90s. One thing I learned in grad school was that, free trade's great for everybody. That's all that matters. And then I learned in the trading pitch, talking to people like you and with clients, I was always on the phones, was, everybody in the world wants free trade as long as they can run net exports with the U.S. There is no such thing as fair trade with the world's most significant demand pull economy. Every country that has free trade with us is at an advantage because there's no way they can reciprocate with decent demand. And he nailed that. So this is, I think, appropriate to do it. We do have to protect our own domestic industries, and those of us from the Rust Belt have seen this happen. So that's the key thing. That's the thing. The thing I want to mention, though, is one thing what's the main reason a CEO in Podunk or in the heartland would shift his supply and close a local factory to offshore and get stuff in from China at very cheap prices? The number one reason is exactly profits. I mean, we're capitalists, and Chinese are trying to play that game. The key thing is, so when you shut that off, what does it mean? The good news is we've still had great tech profits this year, but to me, the big shift is that's going to definitely shift, I think, wealth back to heartland, but potentially away from the stock market, which is mostly the coasts, mostly the wealthy people on the coast. So that's what I'm worried about. It hasn't happened yet, but it's showing signs of it with gold taking off and crude oil going down and cryptos rolling over.
So there's something I want to switch gears a little bit to things like, because I think we all agree that AI trade is stretch. So will you be able to hide out in your Philip Morris's, in your utilities, is there a place to hide within the stock market? Particularly, let's even consider, some of the dividend payers. I don't know why I'm thinking that along those lines, but if I'm not thinking the right way, please guide me to how I should be thinking. But what sort of defensive sectors could be a good place to be if there's coming rumbling under our feet?
I think this is more for Bob, but I'll ask what my thought is. Yeah, you always want low volatility, high dividend paying stocks in that environment. And my thought is, well, we're more traders. Why don't you just lighten up?
Lighten up, or just buy some puts, baby.
That's great for traders, and that's one thing I used to be used to. My key thing, and it's traders need guidance from people like you who really know how to do it. It's so important to not mess it up. And my thought is, now that I'm not allowed to trade options, I'm just like, yeah, just lighten up and overweight risk off assets like treasuries.
Yeah, I hate taking tax events though. Bobby, you go.
Yeah, this is a weird time. And if Luis, if he can put up Remo's comment where he said any concerns on Oracle. If I look at an Oracle chart, it looks terrible. And yeah, I have a lot of concern in Oracle. It's leased down to say $215. It's trading about 226 now. It's down currently. Let me just measure this real quick for you. It's down currently 34.3% from its high. And what that tells me is, yeah, you want to hide out in dividend payers, and yeah, you want to get back into the kind of regular industries that aren't necessarily going to be affected in a negative way by AI spend and maybe the misuse of AI. We know that AI has not had a good ROI for every company that's used it. That's why, I'm looking at things right now because I'm out of everything that's like momentum tech related. Doesn't mean I won't get back in for the reasons that Mike said, is because we're traders, but I really like Walmart right now.
Classic counter recession.
Yeah, they will get benefit from AI rather than trying to figure out how to spend it and what situation it's best going to be spent. I don't like Costco as much, but if Costco actually picks up, I'll get into something like that as well. And then food. I think food is one of the ones that you want to look in, is sort of like the Constellation Brands type stuff. Although it's getting hit pretty bad from the Maha movement at this point. But I honestly don't expect that to last. So I'm sticking right now with Walmart. I'm looking for signals from Target, from Pepsi, from Constellation Brands, things like that. I don't have them yet. And then, Altria, formerly Philip Morris.
Can I follow up on Walmart?
Sure.
It's been my go-to. Always, I remember buying it back in '99, and then some of it just overweight a little bit. In actually '06, I remember '07, I started getting out of everything. The problem, I think Ed Yardini part of this problem I have with Walmart, it trades 40 times earnings. It's a retailer, 40 times earnings. That's the highest since 2000. I mean, it's a retailer. I mean, it's just, okay, it should be, if it was 10, 15 times earnings, a low back in 2015 was 11 times earnings. I mean, that's the problem. That's why I think sometimes it just signed, okay, you have a massive stock portfolio. It went up most in any time in history for a 15-year period. Actually, you have to go back sometimes back to, I think, only the peak in the bubble. Just sell. That's what I'm really about things like that.
I'm going to put this on as we talk about Walmart, because Walmart is starting to take a chunk out of Amazon. And actually, Remo just posted that. He put WNT over AMZN. They're starting to take a chunk out of Amazon. I said this, Jimmy. I said this on our show probably 3 years ago. Oftentimes, if you're going to buy something on Amazon that you don't need tomorrow, and at a place like where I live in Southwest Florida, that Prime next day doesn't usually get here the next day, right? Yeah. It's usually a day or two later. It's still pretty fast. But if there's something you don't need the next day, you don't need it because you forgot your wife's present, whatever it was, you go to Walmart, it's anywhere from 15 to 30% cheaper, and you only have to wait one more day.
You got me sold.
Now, the second part about that, Mike, is when Walmart said they were going to raise prices because of the tariffs, Trump basically said, I'm paraphrasing all this, "Are you sure?" And Walmart went, "No, I mean, I guess we're okay." And that's actually when the stock got hit. But now you're looking at it and that's why I haven't bought Target yet. I haven't bought Constellation Brands yet, which is STZ, if anyone's looking for it. I haven't bought either one of those yet because they haven't made the turn. Walmart has.
Yeah. So Walmart was part of on Dennis Neal's show in 2009, I unveiled the Redneck 20 stock index. Walmart was the key component of that. Smith & Wesson, McDonald's, I can't remember what else, but it was all the rednecking of America stocks, which I think it did pretty well, although it didn't actually make an ETF out of it or invest it. What about banks? No banks, right? Because if we're talking about what we're saying, what about the yield curve? You say a flatter yield curve. No, you're actually probably saying a steeper one, just much lower short end rates. What are you saying, Mike?
Yeah, typically it'd be a steepener. Remember I remember learning, I started in the pits in 88. And I remember everybody said, a lot of those people got burned by the crash that, we always were worried about holding on the steepeners. But or flatteners, because the curve steepens so much. Yeah. So I just look at it, is there a certain time you want duration? And I'm still sticking with that. I've been early, but let's look at what's happening so far. My duration mean moving out in the curve. Yeah. So the S&P 500 is up 18% a year. It's massive wealth effect creation. PPI, most inflation numbers are running above expectation, pumping up to 3 versus they're heading near 2 last year because inflation's picking up. But despite that, TLT is up 7%, and the 10-year note yield has gone from about 4.6 to about right now 4.07. I mean, it's dropping. To me, that's telling me the same thing that crude oil is telling me, that the next big trade is deflation when the stock market just backs up a little bit. And that's why I'm still willing to do that trade, and more so now than ever. And yeah, like I said, sometimes if I keep saying the same thing, I'll eventually be right.
No, and by the way, you've convinced me. I'm going to be looking at, because I've never. Oh, by the way, you might find this kind of funny. So it's like 3 years ago, maybe 4, and I'm like, okay, it's time to buy bonds. The yields are justifying that. And I go then they're like, wait a second, I've actually never bought a bond before. I've been trading bond futures for 20, 30 years, and I had to figure out how to actually buy bonds 3 short years ago, which was a point of embarrassment for me. But I will be looking at duration because I actually like your thesis quite a bit. I think that's interesting. So, Bobby, you go, Michael.
Go ahead. No, go ahead, Bob. I want to hear that. I wanted to show you one key indicator I'm watching, and then
show it.
So, which would show this on the chart is the most significant thing right now is 1.63. That's what I show you here. That's the amount of ounces of gold per one S&P 500. You can go back 100 years, and the average was 1. It's breaking down. You can see it's breaking down. It's bounced at the support. It bounced at the support, and it's starting to break down. It's just gold versus S&P 500. That's despite this S&P 500 rallying. But there's one key indicator I want to watch. Let's take off that, and I'll just show you this. This is one of my favorite ratios, the Bitcoin to gold cross. How many ounces of gold per one Bitcoin? I remember starting watching this in basically when I was 1. My eldest son told me about it 2011, and then it broke above 2017. And that's when I started believing. But it's broken down. Just look at this. This is as of today. That key support was 25. It just broke down below that key support that's held for over a year. Last time it was here is right when Trump got elected. So if you bought the day before he got elected, if you bought gold and Bitcoin on the same day, your gold's beating that. That's beating the Bitcoin, despite the fact you have a fraction of the volatility. So this, to me, is a key thing to watch. If this keeps breaking down, the dominoes tumble. And it started again. Also, it's a time of year. If this happened in June, you don't care. It's summer doldrums. But it's happening in November. We all know what happens in November. Bob, we mentioned on this. You get towards the end of the year, you're thinking about that GI Joe with the kung fu grip for your kid. You start hitting stops, and that's what's happening to cryptos. I mean, they're starting to hit stops, I think, and this is a sign of hitting stops.
Jimmy, I got to tell you that in our panel last week, he mentioned trading places, as he just did now. I mentioned Blues Brothers when he was beating up the Bitcoin people. They were booing. I wanted to put the chicken wire around him so that they threw stuff around him. And then there was a mention of what was the other one, Mike? It was literally old guy movie panel.
We are old guys. Let's face it.
Yeah.
Blues Brothers, trading places. I don't remember. There was a third one, but
yeah. And I'm older than you guys.
Fantasia, Mikey. It was Fantasia.
Oh, that's right. Fantasia. Oh, yeah. Well, that's a key thing what's mentioned about that is Scott Bassett mentioned recently, he was talking about that massive deflation in forces out of China. In the movie Fantasia, there's good old Mickey Mouse tries to do his own spell to, have the brooms clean up the castle, and he can't stop it. So his sorcerer, he's a sorcerer's apprentice, and sorcerer has to come back in there. It's an old wise German poem. But Scott Besson used that example of what's happening with supply out of China. There's no natural self-correcting mechanism to stop that supply of deflationary forces, renewables, batteries, EVs, you name it. And so they have to do something alternative. In this country, we have we have the self-correcting mechanism, and we have natural forces. But it's also the key thing. I've been using that same theme for what's happening with crypto supply. There was one crypto in 2009. It was called Bitcoin, and now there's 26 million listed on CoinMarketCap.com. We all know what happens with unlimited supply. That market's getting crushed, even though there's like an index would have a survivor bias, and that's the thing I keep pointing out. This Bloomberg Galaxy Crypto Index is getting hammered on the year now. So that actually, the original, I think we might have read the same books. That was from another book called Nexus by Yuval Noah Harari. He wrote Sapiens. A lot of people know that one, or 21 Lessons of 21st Century. And he used that example of what's happening sometimes can happen when you don't have a self-correcting mechanism. It's like the sorcerer's apprentice who can't stop the spell of trying to clean up the castle.
Well, thanks, Mike. Now I can't sleep nights thinking that everything's going to collapse. Thanks, buddy. It was great seeing you again.
Well, you buy some
three comments I'd like to go into if I could.
Bobby, we're never having Mike back on the show. No, I'm kidding. This is great. Tell the people where they can find you, Mike.
Oh, on your show, man! I hope to come back. This is just being able to banter with traders like we have. We've been seeing a lot of good markets, and that was a key thing at the show that Bob and I said. I was hoping they would boo me. I did that intentionally because I want to come back next year, and I hope they can tell me I told you so. But there's certain times in your life you have to say, hey, I'm going to warn you because I got to warn you. So yeah, on your show, on X at Mike McGlone 11, on LinkedIn, Senior Commodity Strategist Mike McGlone, and also in the Bloomberg Terminal if there's any clients. And if you are clients, I'm at your service.
I'm a client. There's my Bloomberg in the background. Yeah.
Oh man. So I'm definitely at your service, Jim.
I used to have 5 Bloombergs for my team. Now I just have 1. Now little old me. So man.
Yeah. Well, that's a major statement to have a terminal.
Anyway, thank you so much for being here. This was a great conversation. Bobby, I can play us out.
Yeah, you're all good.
Thank you guys for joining us. I totally appreciate it. All the DMs, all the messages you guys give us, and the retweets. We are humbled by your support. I'm Jim Iuorio. That's Bob Iaccino. This has been the Trader's Edge.
Thank you.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.